Monetary reform, the case for deposit banks and receipt money. Merchants were the first bankers, providing credit for commerce as long ago as 2000 BC. Banking became more formalized in ancient Greece and Rome. Fast forward to Renaissance Europe, and the banking families of Italy established networks throughout the continent. Banking expanded during the Crusades as cash was needed to finance armies. Peasants took their goods to market to sell for cash, needed to pay taxes and rents to landowners, and huge amounts of gold and silver flowed into and out of Europe. The age of exploration and discovery brought about an undreamed of expansion of commerce and trade, and the inflow to Europe of precious metals taken from the peoples of Central and South America. Because of its strategic location and liberal economic policies, the Netherlands became in the 16th century Europe's great financial center. Coinage and bullion from all around the world passed through the hands of Amsterdam merchants. The Dutch were the world's most efficient shipbuilders at the time, enabling them to dominate world commerce. The need for a strong banking sector brought about the next important innovation. In 1609, the Bank of Amsterdam, backed by the city, was established as a deposit bank. Historian Emanuel Wallerstein describes the importance of this new financial institution. It quickly became the great center of European deposit and exchange because it provided a security and convenience rate in the annals of 17th century banking. Over the century, deposits rose from under 1 million to over 16 million florins, and it became the place of retreat for owners of capital who feared for the safety of their wealth. Once enough bullion and coin was deposited, Amsterdam held the key, so to speak, to Europe's international payment system. What made the Bank of Amsterdam unique was its role in turning bullion and multiple forms of coinage into coinage of a standard weight and measure, held on deposit for customers, who were issued receipt money to evidence the specie held by the bank. Adam Smith explains how the bank earned fees while functioning always with full reserves. This bank received both foreign coin and the light and worn coin of the country at its real intrinsic value in the good standard money of the country, deducting only so much as was necessary for defraying the expense of coinage and the other necessary expense of management. For the value which remained after this small deduction was made, it gave a credit in its books. Unfortunately, by the mid-1600s, the committee of city government officials who administered the bank's operations began allowing depositors to overdraw their accounts. Later still, the bank extended large loans to the Dutch East India Company and to the municipality of Amsterdam, loans exceeding the bank's own deposit balance. The era of full deposit banking was over. What could possibly go wrong? Economic power was shifting away from the Netherlands and toward England. In 1694, the Bank of England was chartered. William Paterson, a Scot, raised £1.2 million from subscribers, which was then loaned to the Crown. In return, the Bank of England became the government's banker and debt manager. The government's taxing powers were relied upon to provide funds to the Bank of England should the need arise. The global economy now entered a long period of fractional reserve banking. By the early 18th century, Britain was on a gold standard, formalized in 1821. Other countries, including the United States, followed Britain. Banks were required by law to hold on deposit gold coinage equal to some percentage of banknotes printed and loaned or spent into circulation. The central banks acted as lenders of last resort in the event member banks could not meet the demands for cash by depositors. This arrangement ended in 1973 with the collapse of the Bretton Woods Agreement. There's no longer a requirement that any bank, even a central bank, hold gold, although many do. Global banking has functioned as a no-reserve system ever since. Paper currencies, redeemable in nothing in particular, are issued and held as reserves. Other financial instruments considered liquid, such as government securities, also make up a portion of bank reserves. The result has been almost continuous monetary expansion, accompanied by rising prices of goods and services in terms of legal tender currency. And of course, periodic panics and losses of confidence triggering deep and prolonged financial and economic crises are a constant threat. I believe a return to a network of deposit banks creating coinage of a standard weight and measure of gold and or silver would bring stability to the world's monetary system. What would this system look like, and how would it be created? History tells us that over time, what people most trust as a storehouse of value is gold and silver. Receipt money could be backed by other tangible goods, such as construction bricks, an idea put to Russian officials in the 1990s by one U.S. professor of economics as Russia struggled with the introduction of market forces. But a good starting point for the assets of deposit banks is gold and silver coinage. One issue, of course, is how much of these precious metals can reasonably be minted into coinage and held on deposit. Many countries have a long history of minting gold and silver coinage. To collectors of rare coins, they often command a price far in excess of the current market value of the precious metal out of which they are minted. Governments, in effect, sell money at a profit in order to raise legal tender to pay for public goods and services. This collector's market for rare and limited press coins would certainly continue to exist. Here are the gold reserves held by the top 10 countries. The United States with over 8,000 tons. The mines of Peru, Australia, and Poland produce the largest annual additions to the quantity of silver mined, followed by Chile, China, Mexico, and the United States, Bolivia, and Russia. Ideally, representatives from the countries that either hold existing reserves or control in-ground reserves would sign a treaty agreeing to monetize some portion of their holdings of gold or silver, minting coinage according to universal standards of metallic content. The coins would be held by publicly owned deposit banks as full backing for a new form of receipt money or its digital equivalent. Thus, the value of the receipt currency would be uniform throughout the world. Holders of any form of fiat currency now circulating could exchange these currency balances at whatever exchange rate the market determines, subject to agreed upon levels of expansion in the supply of new coinage each year sufficient to meet the need for credit in the global economy. Private individuals, business entities, and other organizations would become members of the deposit bank by purchasing gold and silver in the open market and opening an account with one or more deposit banks based on their commercial interests and needs. Members would then be able to buy and sell goods or services with other members with automatic debits and credits recorded. Bad debt expenses would essentially disappear. Existing commercial, savings, and investment banks would become a member in the same way, thereby establishing an account balance against which they can make loans to third parties at interest based on risk and the opportunity cost associated with the temporary transfer of purchasing power. Of course, lenders could suffer losses if those to whom credit is extended fail to repay what is owed. This is but a rough presentation of how such a system of deposit banks issuing receipt money might be introduced today. A version of the monetary law put forward by Thomas Gresham is anticipated in reverse. Fully backed paper currency and bank balances will drive out fiat currency and fiat currency bank balances over some period of time. This process will need to be efficiently managed during a period of transition and retirement of circulating currencies. A new Bretton Woods conference would be needed to work out the details.